Hey everyone, in this video I'm going to discuss what SoFi stock investors need to know about the riskiness of its personal loan portfolio. Now, why is that something you should even care about, right? You're asking yourself, you know, why is this something that I as a SoFi stock investor need to care about? Well, I'll show you why. You look at SoFi's portfolio of loans, its originations, they have three segments: student loans, personal loans, and home loans. And you look at the most recent quarter, we have here fiscal year 2023 Q1, right? That's the most recently completed quarter. They did 500 million in student loans, 2.95 billion of personal loans, and a meaningless amount of home loans, right? So it's business essentially out of the 3.56 billion in loans, 2.95 was personal loans, right? The the vast majority of its business has been personal loans. That hasn't always been the case. You look at its loan portfolio in 2021, it was, 4 billion in student loans, 5 billion in personal loans, and 3 billion in home loans, right? A nicely spread loan portfolio, right? And then in 2022 it got worse. 2.2 billion in student loans, 9.77 billion in personal loans, and just 966 million of home loans. And in the first quarter, that trend even worsened, right? It became more concentrated in personal loans. So personal loans are now a very, very important part of SoFi's business. So for that reason, it's important to know the riskiness of those loans that SoFi is making. So that's why I wanted to make this video and share with you the riskiness of that. And I was inspired by to make this video by a question that was asked by a JP Morgan analyst to a to SoFi's management. The analyst said, "What are your loss expectations for your most recent cohort of personal loans, and how does that compare to the 2022 cohort?" So Anthony Noto, the CEO of SoFi, jumped in to respond and say, at a high level, since 2018, we've architected our personal loans in a way that'll drive at least 40 to 50% variable profit margin. And that includes all the variable costs, including loan losses and funding costs, right? So incorporating all of that, we still plan to make between 40 and 50% variable profit margins. But as it relates to macroeconomic conditions impacting life of loan losses, meaning if there's a recession, how will that impact the portfolio? And the CEO says, we'll just tighten credit. We've tightened credit in the past. So if we do get into a recession, we'll just make it very hard to actually get these loans from us. So in the event of a recession, we'll stop or will reduce significantly making these loans. So far we've been below our target loan of losses of 7 to 8%. So that's their target life of loan losses, meaning the default rates on these loans between 7 to 8% is the target. But they go on to say, like right now, the annualized charge-off rate is just 2.97%. They've planned for 7 to 8%, but so far it's only been 2.97%. And that's understandable because ever since the pandemic, consumer balance sheets have been relatively strong, right? There's been a lot of stimulus money pumped into the economy. Job growth is strong, unemployment is really low. So there isn't a scenario where consumers have felt the need to default on loans, and so it's really, really low right now. But that's not always going to be the case. If we go into a recession, if unemployment increases, if job losses increase, then that might raise these default rates, right? But if you take the weighted average life of the loan, the losses are about 4.5%, which is still meaningfully below the 7 to 8% risk tolerance that we have today. Overall, what the takeaway from this video should be is, number one, that personal loans are making up a much higher percentage of SoFi's business. And number two, they are performing very, very well up until now, right? They're performing better than it's expected, historically. And that's due to the short-term factors of consumer balance sheets being healthier, unemployment rate being extremely low, and that's kept these default rates low. And so for now, it's okay, and it's way below where SoFi has planned for. SoFi has uh, margin of safety here between where it is now, the 4.5%, and where they planned for 7 to 8%. So even if these losses increase, SoFi has a built-in margin of safety to absorb the higher rate of losses. All right, so that's what I think SoFi stock investors should know about the riskiness of SoFi's personal loan portfolio. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.